we've been through an extraordinary period where low interest rates, as of one of my guests said the other day, low interest rates, they get into all the cracks. And then when interest rates go up, and so the stuff in the cracks expands, we don't know what's going to break. We don't know where. We have a vague feeling that something will break. We don't quite know what. So we're slightly on tenterhooks thinking what's going to happen next. We know that it probably isn't possible to go from a period of interest rates at zero or negative to a period in which interest rates go back to historical norms and get away with it.
Yeah.
When I gave talks, I used to take a chart of interest rates going back over a couple of thousand years, which the Bank of England produced. Fantastic chart that showed interest rates, wobbling around the place for thousands of years and then dropping down to almost zero and staying down there at almost zero for however long it was. And I would take this chart and I'd hold it up and I'd say, this is the most dangerous chart in the world. And then, of course, I realized when interest rates started to go up, I realized that was absolutely not the most dangerous chart in the world, because as long as interest rates were incredibly low like that, then, maybe nothing bad would happen because you have free money all over the place. What was really dangerous was when they started to go up again.
Yeah. That's
the really dangerous moment. And that's where we are. And we don't really know what's going to happen. So kind of exciting for podcasters.
Yeah, good for content. Yeah.
Good for content, yeah. but bad stuff may happen.
Well, we see it, say if we just look at the housing market, which is a relatable example, it takes time to feed through, doesn't it?
It does. I mean, they always said that, they used to say in academic stuff that an interest rate rise would take a year to 18 months to feed through to an economy. But it takes longer now because the housing market is a classic example. So many people are on fixed rates, and quite right too. And anyone who didn't manage to fix their rate at 1 or 2% during the great low interest period, very bad luck for them. So it takes longer and longer because you've got these 5-year things and 2-year things, and people roll off bit by bit by bit. And you can see in the housing market that it's slightly frozen. Transactions are massively down because no one knows quite what to do. But there aren't as many forced sellers as you might expect in a very fast interest rate rising period because of the fixes. And you see it in the corporate world as well because, company managers aren't stupid and can see that interest rates were far too low. So everyone locks their debt in for longer than they might have in the past. So again, we don't quite know when the crisis is going to hit individual companies. And then on the other hand, you have companies that are doing incredibly well. The very, very big tech companies in the US, for example, they have piles of cash, which they're now getting 4 or 5+%. So, that's a bonus for them. So it's complicated, but interesting. And you're right, the housing market is one of the places you see it. And loss-making companies, the growth companies, disappearance of the SPACs, etc. You can see it in those obvious places, but there will be non-obvious places.
Yeah, you get like a Wilco collapse, which might have been predictable because you're like, that's clearly a business hanging on by a thread anyway. But what do you think might happen? I don't want to put you on the spot, but do you have any non-obvious predictions of where that you might see the cracks?
Well, I mean, if you look back to what happened during the Truss government, very brief Truss government, that came out of the blue. That was entirely unexpected. No one really quite understood the interaction between gilts and pension funds. So that was completely bemusing for almost everybody. So that's an unknown, unpredictable. But what you're more likely to see is just a sort of slow rise in defaults and the resetting of capital allocations. We've been through a period where capital has been horribly misallocated. We've talked about SPACs and talked about companies that make no money, who shouldn't have received money, etc. So what we will see is a correction of that as capital begins to be more efficiently allocated, which, by the way, is a great thing. It's a great thing. It's painful, but only by allocating capital correctly can we bump up productivity and reset our economy and get real wages up and all that kind of thing.
Do you think then that the current resilience in the market will be short-lived?
Oh, yes.
That's what I like to hear.
I mean,
you want to buy the dip?
I want to buy the dip. I always want to buy the dip.
You always want to buy the dip.
I love the dip.
7-7 guy.
I love the dip.
It's 7-7.
The UK market is cheap.
Yes.
So, that's not quite so much something to worry about. We're cheap on every single level. We're discounted, trading at a discount to every single market out there. And that's even when you take account of the differences in the makeup of our market, say the American market, lower tech, more resources, et cetera, slightly older companies. Even so, we're trading on a fairly intense discount, and that's particularly the case with medium and smaller companies. So I think you can probably, and not financial advice, by the way, but you're much safer buying cheap companies at a time like this. If you're buying for the long term and you want to be safe, then you want to buy something that is already not overpriced. It's much more risky to buy into expensive markets, with the US being the classic. Although if you take out the big seven, take out the very expensive tech companies from the US, it's not nearly as expensive as it looks on the face of it. But it's pretty expensive relative to history. So that's a much more dangerous place to be if you're expecting nasty stuff to happen. And I think that there is a risk at the moment where everybody believes that interest rates are going to start coming down quite quick. There's now a consensus opinion that the inflation scare is over, that the central banks have sorted all this out, which is very bizarre, by the way, given that they didn't seem to have any idea that inflation was going to go up, didn't seem to have any idea that that was going to happen. And we now think that they've done a brilliant job in bringing it down. And it's all over because they're so clever. It's amazing how we can sort of shift from opinion, isn't it? So I wouldn't be too confident in that. Once you get inflation up to particularly high levels, it tends to be very volatile afterwards. We had one guest who I spoke to about this, who'd done research that showed that once inflation goes over 8% in a developed economy, it takes an average of 14 years, not 1.5, 14 years to bring it back to target.
Jesus Christ.
And it tends to become extremely volatile. So it is entirely possible. Everything is possible. It is entirely possible that we've been through a period of very high inflation, that it was entirely transitory, that it's now nearly over, and then we'll go back to having inflation knocking around 2% forever from here. Possible, but
Not
based
probable.
on history, fairly unlikely. Yeah. So I think you have to expect as your base case that over the next couple of years, at least, inflation will be higher than we've been used to and more volatile than we've been used to. And that's not good for markets. Markets like low, steady inflation.
So do you think that's on like the core numbers? So the domestic based inflation instead of, say, the more volatile stuff, which is food and energy, which was the main driver? Because a lot of the fixing has really just been external factors in the UK that have declined again, food and energy, which is not really central bank policy, is it?
No. And, that was the case on the way up and the case on the way down. And our politicians can tell us that they've done an excellent job in halving inflation. But of course, as you say, this is mainly global stuff. But food and energy prices more likely to be volatile now than they have been in the past. And this is partly to do with our energy transition. Of course, we're trying to do something incredibly expensive and very unusual. We're trying to make a transition from an incredibly dense and efficient form of energy to a not particularly dense and not particularly efficient intermittent source of energy. And that's expensive. It's expensive globally.
Yeah, 50 billion a year, I think, was the forecast that we'd need just for the net zero, leading from now until 2050. They talk about efficiencies on the other side, but we've still got to find that money.
Yeah, and our politicians are very keen on talking about the transition, the energy transition, as being a growth opportunity, but it's actually a cost.
Yeah,
I mean it's
certainly
big,
for the first
cost.
10 years it will be a big cost.
Yeah, maybe forever.
Yeah,
we're giving ourselves a more expensive and less reliable form of energy that's expensive, volatile, erratic, and comes with all kinds of difficulties. So I don't think you can expect energy prices to fall back and just stay steady.
No,
that's not how it's going to work.
No.
We had an awesome chat with Marion Somerset Webb. Check it out right here.